Hey, welcome back to Everything Money. We're glad you joined us again. As always, it's Seth, Paul, and Mo. Today we're talking about Tattooed Chef. Paul, this stock is just, for me, it's a little frustrating at times.
It's a love-hate relationship.
Yeah, so you and I have done some videos of these. Actually, when we were in Mexico, your beautiful Mexican house in January, I said, there's some chatter about this. Let's take a look at this. For some reason, the financial data has never matched up with our software, with Y-Charts, with Google Finance. But
us and Y-Charts has been correct.
That's right.
Has been similar, but Google Finance has had different numbers, which I actually look at Google Finance and think their number might be a little more accurate.
But regardless, folks, if you're scouring YouTube looking for information on Tattooed Chef or just investing in general, there are so many people talking about how great this plant-based food company will be. And they have been for months, Paul. Now, as we know, the deeper and deeper I learn about this, and I learn from you, is like, there's just a barrage of hype surrounded they pick some random companies, Mo.
Yep.
If it's the meme side, it's like, it makes no sense.
It's crazy.
And they just, somehow they get together and pick these random companies, and then they keep jumping on board. Next thing you know, it's this echo chamber of the Tattooed Chef is the best thing ever. Well, sure enough, we had videos in January that we put up, and the financials were all over the place. We ended up taking them down because the financials were incorrect. But regardless, I think the trend is the same, Paul. This stock has since somewhat collapsed since its highs. And sure enough, like most hype channels, it's like when it's going up, it's a buy. And then when it's going down, it's a buy the dip. There's never bad news with this. It's still the best thing ever. And anyway, any general search on YouTube can find how everyone just loves the stock. So I would like to deliver to you perhaps the opposite opinion about a company, just to maybe be careful out there. It is, if you're a young or new investor, it would seem that Tattooed Chef is a great investment. It's just everyone else is saying it, much like the Teslas and the Bitcoins out there. This has to be wonderful. And I would love to show you someone who's been investing a different way for the past 20 years and been wildly successful at it, Paul. So give us your thoughts on Tattooed Chef.
Thank you, Seth. First off, guys, follow us on Instagram. Mo and I, we're trying to get our blue check marks. It's very important to our vanity. So when it comes to any sort of companies that are growing fast are very exciting. You look at this company, and back in January, here was the stock price, $26 a share, right? Now it's 16. Does that mean it's obviously bad? No, it doesn't mean that. Look at Alibaba. Alibaba's plummeting now,
yes.
And I'm a fan of it. I'm keep buying more, right? And I hope all my stocks that I'm buying, Walgreens, Intel, Alibaba, HPQ, are going to go down so I can buy more.
No, make sure you clarify that, because that sounds silly that you want to buy a stock and have it go down.
As I always tell people, what's your favorite thing in the world to buy? Is it shirts? Is it clothes? Whatever it is. Investments seem to be the only thing that people want to buy more of as they go up in price, which always boggles my mind. Now, with Tattooed Chef, all I was making the argument is this seems like a very hyped up stock. People are buying it because it's exciting because they saw this, right? They see this and think this is going this way. I see this and think, okay, temporary overhype, especially when there weren't amazing fundamentals. Now, was it growing fast? Of course, guys. Look at Google Finance over here. Just in June, 45% increase from the previous June, right? Look at March, quarterly, 58% increase. December of last year, 47. It is growing like crazy. My entire thesis is based on, can you overpay for growth? A lot of people would say no, to which I say, well, then if you don't think you can overpay for growth, scratch that. They'd probably say, yes, you can, but their actions would say otherwise. But my argument is, if you're willing to pay because it's growing 45%, does that mean 80% isn't better than 45? What's the right number you sit there and say, well, at this point, this growth is enough? You don't have that number. It's not based on fundamentals.
I think this is where people have a foggy sense of how to invest. Growth seems like great. This is a growth stock. So how would it ever stop? Why would it ever stop? It has since slowed down a bit. So tell us, Paul.
Well, I always bring this example. Great. Which one has better growth?
Obviously the bottom.
The bottom one. But if I only showed you this company, you'd be like, well, I'm buying this like crazy because look at its growth. Oh, great. Isn't this better?
Yes.
This is way better. People have a hard time of understanding that you can overpay for growth. Every investment is the present value of all future cash flows. Those cash flows include any cash coming into the business, any refinance money, and an exit sale at some point in the future. And that's what our software does for people. So I look at this saying, when you only look at growth numbers, you don't look at what's behind those growth numbers in terms of what you're paying for it, you have a problem. The other thing with Tattooed Chef is their number of shares outstanding has skyrocketed in the last year. And this is something that people don't really realize.
This is literally the number of shares that exist in the world, and companies will issue more if they want to raise capital to do more things, Paul. But with Tattooed Chef, it seems alarming.
Just look at September of 2009, 65 million shares outstanding. Today, 82 million shares outstanding. This is a 30% increase in the number of shares they have outstanding. And guess what, guys? As small companies grow, they tend to issue more shares, especially overvalued companies. When you're overvalued, you want to issue more shares because your comment internally is, look at all these suckers out there who are willing to overpay for our stock. Let's give them more shares so we don't have to take on debt to grow. So we have to give away equity to grow. We can give away, actually, they are giving away equity to grow here. Go ahead, Mo.
I think you should break down what share dilution actually does to the shareholder, because I think maybe a lot of new people who are invested in Tattooed Chef, maybe they don't understand what that shares outstanding number really does mean.
So let's say there's a company that makes $10 a year and there are 10 shares. That gives every shareholder $1 in profit per year. Now let's say they increase the number of shares to 12. They still make $10. All of a sudden now you're getting 83 cents per share. So you're down from $1 per share to 83 cents a share, right? They go to 15. Now you're at, 66 cents a share? So same profit, but all of a sudden you're splitting up amongst more owners. If you own one share, you go from owning 10% of the company to 8.33% to 6.66%, all from them just increasing their shares outstanding. In this situation, they increased their shares by 30%, let's say. So they took their 10 shares to 13. Now you own, 6% of the company overall? 7% of the company overall, 7.5, whatever the number is. You went from $1 to 7.5% of the company. We went from 10% to 7.5%. Guys, this is a silent killer for investment that most people don't even understand. They don't look at that part, and this is so important. The same goes the other way. When companies that are undervalued are buying their shares back, they're giving you more of their company as a way of driving up your share of the company and your share of the profit. And small companies that are growing fast will dilute you. So as an example, if a company that's making $10 per share goes to 20, but their number of shares goes from 10 to 20, not in a stock split, just issuing more, guess what? You gain nothing as a shareholder.
Yeah.
They doubled their profit and you gain nothing. That's the problem. So even though their revenue is up 45%, they increased their shares by 30%. So you didn't get that much of a benefit. And this is where we're trying to tell people, we're trying to teach those out there who are open to it, that there's more to it than just looking at these numbers. There's things the company can do to hurt an investor and that people always miss, right?
Or they don't know to look for.
Or they don't know to look for. And that's why you're here to learn, because this gravitates towards you. I'm not trying to be Debbie Downer. I'm not trying to be negative. I'm very optimistic about the US economy and the stock market over the next decades. But temporarily, for the next 5, 6, 7 years, it's going to be a rough go of it for stocks. Just based on valuations, and history has shown this. Does that mean you can't find value? No. But I just always advise caution when it comes to overhyped stocks, that the average person on YouTube who has no backing for it, has no reason for it besides they see a lot of hype and they're trying to gain money from YouTube watchers. Just be careful. That's all I'm asking you to do. Look at it as if your neighbor came to you who owns a mechanic shop and said, hey, come buy part of my mechanic shop. You would do your due diligence. You'd look at the financials. You'd understand how you're going to get your money back.
That's a no-brainer for most people. I mean, if you were to buy a business, what do they do? What do they make? How much money do they make? And how much,
I always bring the example. One of the biggest Tesla fanboys I know owns a house in Mexico near mine. And when I offered him a share of a house I was buying, he said, well, let me see your business plan. Let me see what you're trying to do with that. I'm like, oh, suddenly this matters. Suddenly my plan matters. And it was very interesting to me that he looked at a stock very different than he looked at an individual business, but the exact same thing.
And you say this too, Paul. You say, a dollar bill is a dollar bill, but I've used this reasoning against someone who was arguing against it, like investing in Tesla and Bitcoin. I said, at the end of the day, a dollar bill investment is a dollar bill. And he said, yeah, I'd hate to only make a dollar. I'd like to make 10x, 100x that.
And guess what? Growth does matter. If a dollar today is still a dollar today, no matter where it comes from. However, if another company was going to make $3 tomorrow and that other company was going to make $1, I would pay more for this. But what happens in the market is people go, look at that growth. I'll pay 10 for it. This company's not growing. I'll pay $2 for it. Well, I'd rather own this company at $2 than this company at $10.
I think that's the gist of it, right?
That's the gist of it. Are you overpaying for that growth? And usually the answer is yes. Growth is way more exciting. I like growth. But I like growth. It's just a little bit of growth. Why? Because people tend to ignore a little bit of growth. They want the 30, 40, 50% growth. Like, oh, this is going to the moon. Well, go look at 2000. All those companies on the internet had the world in front of them. They were going to change the world. How many of them went under? 90% of them, 95% of them went under, went to zero. Why? Because it just didn't work. It's no different than today. Do I believe Tattooed Chef? I haven't looked at Tattooed Chef in terms of, and for those of you out there who are going to criticize and say, you didn't do your due diligence. Exactly. I don't need to do my due diligence on a company to see that they're diluting me, that people are overpaying for the revenue and profit. I just look at it saying, guys, I don't understand how I can justify. There's so many other options out there that I think are obvious value plays to me. Why would I go find the hype so I can hope that this one, by the way, what's market cap of Tattooed Chef?
I think it's about 1.3 billion.
$1.4 billion.
$1.4 billion.
Okay, great. What can they become? Can they become a $50 billion company? Sure. But what's going to happen between, the future is unknown. Mm-hmm. Yet whenever it comes to hype, we always think the future is a direct line. Oh, this is obvious. Oh, is it though? Is it? I look at it going, this company doesn't even make money.
Yeah.
I mean, well, maybe they do make money. Let's look at see their numbers.
Cisco and Intel were the same obvious situation back in 2000.
So their recent net income was they brought in $50 million in revenue and they lost $53 million. Sick! So they spent more than they even brought in revenue.
It's just not as fun, Paul, to have this disciplined in value investing mindset.
It's not fun.
Where we find boring companies.
It's boring.
And so when you say the words Tattooed Chef at a party to your friends, like 10 people light up as this is the best thing ever. Meanwhile, I'm the guy in the corner like, these people are bonkers.
Well, the good news is we'll still be your friend. Tim will be your friend, won't you, Tim?
Thanks, Tim. Mo, are people trading Tattooed Chef in the Bid-Ask Nation?
You know, to me, this is not something that you want to take some kind of long position. This is more of like a swing trade or a day trade. Because when you get these, let's go to the daily chart and just look at these surges of volume that you get every once in a while. Because this is not something that value investors go to, and it's not something that your financial advisor is typically going to go to. But every once in a while, especially on earnings, you're going to get these little pops, and you can take advantage of those. And I would go and swing trade those, or more importantly, I would go and day trade those because, Seth, as you know, when you get pops in volume like this, you can go and just crush it in the day trading area. I mean, you could probably make 4 and 5% in a day.
What kind of volume are you getting on those huge?
So this big one right here, that's about 10 million. These little smaller ones are about 4 million, and then consistently it gets 900,000 to 1 million. So you can see that people are really, it's hype when it's hype.
Paul, is it possible that 4 or 5 hype YouTubers get on a train of talking about the stock over a week and can manipulate stock prices like this? I mean, if there's 1 million trades in a day and someone has 600,000 followers, I'm not saying all, obviously, a very, very small percentage might actually trade this, but why are people
and don't forget, when you get that kind of volume, it's not only YouTube, it's CNBC, it's Fox Business, it's all of these it's every avenue of media that's going after it in that specific time frame.
Are we supposed to play into this game, Paul?
So it's not my strategy. Do I believe momentum investing can work? Absolutely. I'm a big believer in momentum investing. I talk about Turtle Trading Book. I'm a big believer in that, but there's a process to it, not just because some hype guy says, buy this company. You know what I mean? So you can make money in momentum. You can make money in anything as long as you have a set process that's very defined and you follow it to a T. It's been proven time and time again, when humans bring their own emotion into investing, it tends to end up being bad because they sell at the wrong time and they buy at the wrong time, right? Yep. So we have our stock analyzer tool on our software. Now, I'm sitting here and saying, let's look at the situation. They did 113% revenue growth in last year. Great. I'm looking at a 7-year analysis. I did 30, 40, and 50% revenue growth. Do I think that's right or wrong? I have no idea. But to go 7 years of 50% revenue growth a year is a very, very difficult task. Does that mean it's not possible? No, of course it's possible. The question is it probable? Now, shares outstanding. I'm being very, very low. They did 26% increase in shares in the last year alone. I did 10, 12.5, and 15% increase in shares. According to this, it should be, but I also didn't go as high on the revenue growth, so I'm going to be conservative on the share change. Mm-hmm. Profit margin, I went way higher on the profit margin, 579. Free cash flow did the same thing. Guys, PE, I did 20, 25, and 30. I think this is way too high, but I'm just trying to prove a point here. I hit my analyze button. Guys, I don't even have it worth, only if your assumptions on the high side are accurate, does it make sense to own the stock. literally anything else, I look at it going, okay, well, a lot's going to happen. So really, if you buy it today, you're going to do very, very well, assuming everything I did above actually hits. Listen, I think Amazon's a great company. They didn't hit their revenue numbers and profit numbers for like 15 years. Like literally analysts were wrong time and time again, going out 5, 6, 7 years. It's just very difficult. It's extremely, extremely difficult. And I think those dilution, I think they're going to dilute people even more than that 10 or 50. I think they're going to dilute people maybe 20, 25% a year for the next few years just to be able to justify their growth levels.
That's typically what those companies do. And then on top of that, assume that they can do 50% revenue growth for 7 years in a row.
It's just it's a tough.
Everything has to fall in line perfectly.
It just could it work? Absolutely. But I'm just sitting there saying, if you have 100 tattooed chefs, you're going to lose a lot of money on 98 of them, and you might find the 2 that hit it, and you probably won't make your money back. I always bring the example of .com numbers. So if you invested in every .com stock back in 2000 and today, you made 3% a year. The market did about 7% a year. And of that 3% a year, 80% of it was Microsoft, Apple, and Amazon. And Amazon's up 20 times from its peak of 2000. So you have to be right on. So even then, you didn't beat the market picking all the .com stocks that, by the way, had the future potential of the world. Nothing was going to stop them. This is the world of the internet. It was changing the world, and it did change the world. But still, companies can fall even when they're changing the world. That's just the bottom line.
You'll read in the comments below that we don't get the growth. We're wrong about this one. And I implore you to maybe read a book about the most famous investors in the last century. They all think this way. They can look at a company and then literally in the first 30 seconds see if it's a buy or an avoid. And for months now, Paul, this has been very obvious for us. People want to buy companies that are undervalued. This is a no-go. So be careful out there. Be careful who you're watching, because they might certainly be using your views to make money. And we're just trying to teach a process here. So, Paul, I appreciate your insight. Mo, as always.
Of course.
Make sure you follow a thumbs up. If you want this software, join our Patreon below. And yeah, that's our take on Tattooed Chef. Join us next time. Thanks for watching.